Welcome to the latest Evershed Sutherland Legal Insights podcast.
Hello and welcome to our new podcast series where we will explore all legal and regulatory matters relating to consumer credit and mortgages. My name is Joanne Owens and I'm a partner in our retail finance team, and I'm joined today by Rachel Browning, a senior associate in the team.
Hello.
Our aim is to publish a regular podcast providing quick and informative updates about developments in the consumer finance space. And in this podcast, we wanted to bring you a roundup of some recent developments outside of the consumer duty and buy now, pay later, which have been covered in separate podcasts that we've published.
So let's start with the Financial Services Consumer Panel's position paper and research on how vulnerable customers choose and buy equity release products.
Great idea.
There is a lot being published at the moment focusing on the voice of the consumer and how this needs to be front and centre of both FCA regulation and the boardroom. The panel's position paper and research seeks to explore whether the way in which equity release is currently sold is achieving good outcomes for all consumers. The paper suggests that the work done by the panel indicates that the prevailing guidance, sales and advice processes may in fact be exacerbating some of the risks faced by customers using this product, and therefore makes a number of recommendations for change. This is against the backdrop of an increased use in equity release to fund short-term funds for essential need, for example, because of a need to support family to get on the property ladder, or as a result of 1 in 3 Generation X consumers potentially reaching retirement without adequate income to support their needs.
Yes, the paper suggests that the research commissioned by the panel indicates that vulnerable customers may be exposed to a risk of poor outcomes and experiences in a number of different situations. For example, customers purchasing the equity release due to necessity or urgency may not shop around or explore alternative options. They also might not seek independent advice.
The paper also flags that customers may be susceptible to marketing material, particularly given the prevalence of TV advertising, but also may seek validation of their choices through informal channels, such as speaking to family or friends rather than seeking independent advice. There's also a risk that some customers may be more susceptible to marketing when the product is being sold in their family home.
And I guess the aim of the paper is to stimulate further work by regulators and industry, and so in a way is bound to raise negative issues because they want the regulators and industry to look at the issues raised and the research, and against the backdrop of the consumer duty, consider whether changes to regulation and standards are required to improve outcomes. One of the really interesting points about the paper is that it's prepared with the consumer duty in mind, and so does raise questions about the product and the way it's sold against the backdrop of these new requirements. Of course, equity release providers will already be asking some of these questions in light of their implementation of the new duty in any event.
Yes, that's right. The panel is asking the regulators and industry to look at how ER is marketed and sold, including the role of marketing and commission-based sales. They also want to know whether regulation and industry standards can do more to protect consumers from the financial and psychological harm set out in the paper, as well as explore the impact of ER and alternative products on consumers and the risks to the FCA and industry as a result of an increasing number of customers purchasing equity release from a position of vulnerability.
And it's interesting that the research seems to highlight that a number of customers have already decided to purchase equity release and have in fact already spent the money in their heads without taking advice, but also that some customers included in the research felt too embarrassed about their financial situation to seek financial or other forms of support from family and friends. The paper also suggests that the growth in mainstream TV advertising makes it more likely that the product will connect with those customers who are more vulnerable.
Yes, on this, the panel would like the FCA to support with the development of tools and guidance provided by an independent body such as the Money Advice and Pension Service to help people understand and narrow down later life lending options. They also want the FCA to consider whether the existing financial promotions regime is working as intended for equity release and to implement recommendations relating to digital marketing. The aim here is to make sure customers are aware of all of the available options so that they can consider these before deciding whether equity release is right for them.
And the paper also makes other recommendations in the context of advice. So here the research suggests that a customer's decision is influenced by the type of advisor consulted, noting that not all advisors are able to provide advice across the broad range of later life financial planning options. So for example, just because an advisor is able to give advice on equity release does not mean that they can then advise on pension planning, etc. So the recommendations seek to explore how customers reach advisors, as well as looking at different types of advice that can be offered and how the existing regulatory permissions regime impacts that choice. They also suggest that the effect of commission or performance-based sales should be investigated to better understand how they impact choice and outcomes. And of course, commission and performance-related remuneration is topical in a number of consumer finance sectors at the moment.
And again, the recommendations seek to explore how the consumer duty may impact how firms establish that their products offer fair value and ensure customer understanding, for example, in relation to standardised disclosure of fees and charges. The recommendations also seek to understand whether a post-sale review would help determine customer recall, understanding and confidence. There are also recommendations made about customer understanding more generally, as it's felt that existing statutory disclosure and processes do not necessarily mitigate the risks that customers do not fully understand the product they have bought.
Yeah, a particular concern has been raised about customers not fully understanding the impact of compound interest and its effect on their equity, as well as customers purchasing a product with particular features but then not using those features post-sale, despite perhaps paying additional sums for having access to them. And it's these things that have led to a certain level of customer regret included in the research or expressed through the research. But I guess on a positive note, the volume of complaints made about the product to the FOS and the FCA is very low. The paper is well worth a read, particularly as it raises questions about how the new consumer duty may impact certain aspects relating to the sale and marketing of equity release, as well as the utility of post-sale reviews. And this is the first time I've seen publications looking more closely at the impact of the duty on specific products. So it will be of broader interest to those outside of the equity release market too.
Great. Shall we move on to look at the Treasury's summary of responses to the access to cash consultation?
Yep, let's do.
Great. The Treasury has now published a summary of responses to its access to cash consultation. You will all no doubt be aware that the Treasury launched a consultation in July 2021 to explore how access to cash could be preserved against the payments transformation that has taken place over the last 10 years or so. Despite a decline in cash usage, particularly during the height of the pandemic, cash has remained the second most frequent used method of payment as of 2020 and continues to be important in the lives of millions of customers across the UK, particularly vulnerable customers.
That's right. And the summary of responses confirms that Treasury will be proceeding with their proposals and that government will be legislating for access to cash in the Financial Services and Markets Bill. So in summary, the Treasury will designate firms for the purpose of ensuring continued access to cash across the UK. And by access to cash, we mean both deposit and withdrawal facilities. The designated firms will principally be the largest banks and building societies using the criteria that were set out in the consultation paper. And this considers matters such as market share, so the number of accounts and the value of deposits held in those accounts. Further, the FCA will be established as the lead regulator for retail cash access and will be given powers to ensure that the designated firms continue to provide access to cash, enabling customers to deposit and withdraw cash across the UK. And these will include the FCA having the power to address cash access issues both at a local and national level, with the aim of addressing spatial disparities and protecting standards in those communities that have the greatest need.
The summary also recognises the steps taken by industry since the consultation to improve coordinated effects by firms to meet the access needs. In light of this and the role that coordination bodies may play in the future, the government also intends to enable Treasury to designate these coordination bodies to be subject to FCA oversight in addition to the designated firms.
And Treasury will also be able to specify geographic baselines for reasonable access to cash withdrawal and deposit facilities across the UK, and that these will be set out in a policy statement to ensure flexibility for future need. The baselines may differentiate between withdrawal and deposit facilities, with distances for cash deposit perhaps being greater in light of current need and the cost of providing those facilities being higher than for cash withdrawals.
That's right. The baselines can also take account of the needs in urban areas compared with rural areas and the differences between the needs of personal and business customers. They can also detail separate baselines for Great Britain and Northern Ireland. To help the government set the baselines, the FCA will be required to report to the Treasury with information of the coverage of access to cash across the UK. The Treasury will then consult with the FCA before issuing its policy statement and can also consult with the Bank of England, the Payment Systems Regulator and the PRA. Helpfully, the Treasury is going to approach this on the basis of the distribution of existing facilities so as to avoid a redistribution or large-scale reintroduction of cash access points.
And the FCA will be responsible for monitoring the coverage of access to cash and to report to Treasury to inform the Treasury's decision on designation and setting these geographic baselines. The FCA will also have powers to monitor and enforce compliance by the designated entities, which will be broadly consistent with its existing regulatory toolkit. For example, the FCA will be able to ask designated firms for information about access to cash compliance, and they will be able to address any deficiencies in access at local level where they result in adverse impacts on local communities.
Talking about the FCA getting new powers leads us to the final update for this podcast, the FCA's policy statement on its new cancellation and variation power.
That's right, and the FCA has now published a policy statement confirming that it has the power to cancel or vary permissions without a firm's consent when it appears to the FCA that that firm is not carrying on regulated activities within the scope of its permissions, and if certain other conditions are met. And the FCA is basically proceeding with the implementation of the power set out in the consultation paper of September 2021, but with some minor changes.
The new power is set out in Schedule 6A to VISMA. It gives the FCA a streamlined process to follow when using the new power. The policy statement confirms the changes being made to the FCA Handbook and Enforcement Guide to describe the new power and how the FCA will use it, as well as to provide guidance to firms on the FCA's approach to using it. The policy statement confirms that the FCA is prepared to use the power and will exercise its discretion to do so where the relevant conditions are met.
And it's worth noting that the new power cannot be used where an authorised firm is using some of its permissions but not all of them. So it will only apply where it appears to the FCA that an authorised firm is using none of the permissions it holds. And instead, the FCA will have to use its powers under Section 55J of FISMA, and guidance on the use of that power has already been set out in the FCA Handbook. As part of the policy statement, though, firms have been asked to consider the permissions they hold and to apply to the FCA for the removal of any permissions that they no longer need.
Thanks, Jo. As ever, it's all change in the regulatory space, and with that, we've come to the end of this episode. We hope you enjoyed it and that you will join us for our next one, where we are sure there will be more regulatory change proposals to discuss. If you have any feedback or want to discuss anything we've covered today, please feel free to get in touch.
Thank you for listening to the Evershed Sutherland Legal Insights podcast.